Since we were talking about this, 2008 thing, and how honestly it was probably mismanaged. A lot of people missed it, right? What happened back then?
Yeah.
But what happened in March of 2020? There was some really you were telling me about this, and I think it's a really interesting story to understand what happened back then when everything kind of hit the what, right? And there's been a lot of criticism of the Fed for buying mortgage-backed securities, right? And so first off, explain what mortgage-backed securities are.
So in the best way to describe it in layman's terms is really, if you go back historically, it used to be that loans of any type or a mortgage loan, you went to a bank, somebody at the bank went back to the vault, grabbed $100,000, brought it out, gave it to the seller, and the bank would give you, however many years to pay back.
Well, it's like the Wonderful Life movie, right?
Yes.
It's in Joe's house, and it's in anyway,
exactly.
the Smith's house,
But now everybody's loan, and unless you go to a small bank and they do what we call that a portfolio loan. So the bank's going to lend you the money, and they're going to keep your loan for 30 years. Those are few and far between. Rates are usually higher. And they're typically doing those because they need to get creative on the loan, right?
Yeah.
But ultimately, for the rest of us, most of us, your loan is an investment commodity. So you come to me, I take your application, we look at your credit and various factors and say, okay, I can lend you this amount of money at this particular interest rate. But the folks at my headquarters are already hedging those funds. They're going to sell that loan. We sell directly to Fannie and Freddie, although some other servicing bank will actually service it for some period of time, right? So everybody's loan is earmarked to be sold. It's sold based on that interest rate that it's locked at. And then ultimately, big firms take $1 billion worth of loans and bundle them into an investment commodity.
So let me just understand something. Does Fannie and Freddie actually sell those investment vehicles, or do they still keep them on their books? That's what I don't quite understand.
So the way that it works, it basically you are giving people the ability to invest in a block of mortgages.
I got it. Okay.
Right. And so folks are able to buy mortgage-backed securities. They'll often abbreviate that then just call them mortgage bonds. And so you are investing in that based on a block of loans that are sitting at a particular interest rate. And so really the mortgage loan, there are a number of people who are making money off of that loan as an investment in the long haul. It's really most basic or simple for us on the loan side, because for a mortgage banker like myself, we are paid by that investor when they buy the loan. So it's pretty cut and dry.
Yeah.
We do the loan. They say, thank you for this great loan. You get this percentage of the loan amount, and the corporate gets the percentage, and then a percentage goes to the loan officer and so forth and so on, right? But then beyond that, on the secondary market and into the mortgage-backed security market, then those investments get a little more complex. So
what happened in March of 2020 that really... You said something, and I've heard this before, but we were on the brink of the housing market just screeching to a halt.
Yeah, and most of that, when we're talking housing market, we were really talking about banking.
Yeah.
Predominantly mortgage banking, but keeping in mind that consumer banks or depository banks, Wells, Bank of America, they're all heavily invested as well into mortgages. And so what was taking place, and it's hard to nutshell this thing because it is kind of complicated.
Yeah, it is. It is.
So as abbreviated as I could make it, we, rates 3.5 years ago, Tina and I did a mortgage 3.5 years ago. Our loan was 4.75. That seemed really great for the time. And then in February, they just started talking about COVID.
Yeah.
And COVID then began to have an impact on the stock market. Historically, when the stock market declines, mortgage-backed securities do better, which means rates get better. They get lower. Mm-hmm. And so only the stock market was really taking the first significant hit from the COVID news and projected impact on global investments and so forth and so on. And so rates started getting better. In fact, Tina and I refinanced in February at 3.5, thinking that's it.
I did too.
The lowest rate we had before that was 3.875.
Yeah. And
I think we got that in 2009, 2010 after the when we got into the recession. And so everybody, lots of people started to refinance and purchase. And I did see a significant influx of folks buying second homes because it seems like free money at 3.5%.
Right.
And a lot of folks buying investment properties, especially those wanting to do short-term rental scenarios. So there was this huge influx of loans, and some of these loans were sitting there floating in mid-March, but a lot of them got locked. They got locked at 3.5, maybe 3.375, and we went to bed on a Friday in mid-March. I'm trying to remember the date, 8th, 9th, something like that. And we woke up on a Monday, and mortgage-backed securities decided to, for the first time in my mortgage career, follow the stock market in a decline, and they tanked. We saw over 100 basis point loss in mortgage-backed securities, which meant we locked a bunch of loans the week before, which are now sitting at a low interest rate, and today's market, this new Monday morning, we wake up and rates are higher.
So let me just make sure we're on track here. So basically, we have all these loan commitments out there, right?
Lots of them. Yes.
A lot of them. And this Monday comes around, and all of a sudden, the rate for those, the return for those drops substantially, which basically means nobody wants them.
Right.
So you have commitments for this stuff, but nobody to buy them.
And the sheer volume leading up to that crash, per se, in mid-March, the volume itself log-jammed the banking system. This is where regulations, which were good, then began to create issues with banks moving money to each other on the short term. This was before the Fed stepped in and lowered that overnight interest rate from bank to bank, basically down to zero.
Yeah.
And they had to roll back and work around some of the regulations that were put in place because they simply could not move money. And so you'd have a bank with, a couple thousand loans that they locked. They would call the investor, or reach out to contact the investor, and there was no answer on the other line. I mean, everything was log jammed. And we were watching mortgage-backed securities oscillate up and down over the course of several days, as much as 125 basis points.
And a basis point is basically 1/100th of a percent. Yeah,
right.
Yeah.
So we're watching these values, which typically, go on a nice, slow, gradual line. They're zipping up and down, and we're all holding our breath. I mean, we were literally sitting there wondering what happens. Like, where's the fourth quarter Hail Mary touchdown that's going to save the industry?
That's a great segue. So what happened? The Fed stepped in.
Yes.
And that was the Hail Mary.
The first couple
in the Treasury.
a couple of things that had to happen is they had to then, meet and roll back some of those regulations. They had to free up money and make it easier for the banks again to get money to each other and move money around. We had to get liquidity. And then ultimately they needed to stabilize mortgage-backed securities. Historically, they never followed stocks. They would always move in the opposite direction.
Sure.
Every day that the stocks would tank, so would MBS. And so the feds realized the only thing to do was purchase the mortgage-backed securities. And they started purchasing them at, $30-40 billion a clip. And that began to stabilize the market. All that drastic fluctuation that we saw leveled off, but it came to rest with mortgage-backed securities better than where they were prior to those several days of craziness.
Yeah.
And so they settled back into a place to where now rates were where they were at 3.5, 3.375.
Yeah.
We were at 3 even, and maybe on a good day 2.875.
Yep.
And there would be other things that would take place that would drive those rates even lower.
Yeah. Yeah. So now we fast forward. Okay, so we were talking about what happened in March of 2020.
Yes.
And you can disagree with it or whatever, what the Fed and the Treasury did.
Yeah.
The thing is they kept the money flowing. And honestly, it's not much different than what happened in 2008 with Paulson and some of the stuff, again, to keep the banking system working.
Right.
Fast forward to today. The Fed this week came out and said that they're planning on tapering, right?
Yes.
Right. We hear that term a lot. So basically, tapering means they're just not going to buy as many mortgage-backed securities, correct? For the most part.
Yes.
That's part of it.
Yeah, and all these things, as these little subtleties, even just the announcements themselves affect the market.
Right.
So the first time that the Feds used the word tapering, which was months ago, we saw an impact on interest rates that actually set rates a little higher, and that was the new the new base, the new plateau that we were working from. And so they're talking about going from $30-40 billion of purchases down to 15, and eventually they're going to wean off of these purchases altogether.
Yeah.
There's other things that the Feds did in the process too that they had never done before, which was actually buy bad debt. So the Feds got really creative in this market. There's folks that side on both sides of that, But from our perspective and what I saw taking place in the market, they just needed to do something to stabilize things. And in the end, purchasing those mortgage bonds was really the only Hail Mary that they had. One of the effects that took place, though, and they actually tapered back a little bit early in the process, is they ramped up their purchases and a lot of piggyback investors jumped on board.
Yeah.
And so a lot of folks started buying them, and they drove the value of mortgage-backed securities up higher than I'd ever seen. And we started looking at 2.5% rates on a 30-year fixed. It's not that the feds didn't want us to enjoy those low rates, but that's not the effect that they were looking for. And so they rolled back for a bit in the hopes that these piggyback investors would fall off, and they just wanted to keep it stable.
Yeah. And the stability, I think, is the thing that, obviously I think they want.
Yeah.
So we come to today. We've enjoyed these 3%, plus or minus interest rates now for quite a while for 30-year fixed mortgages, which, if people don't understand, 30-year fixed rate mortgage is a rarity around the world.
Yes.
We in the United States have it really, really good when it comes to this, right?
Yes.
3.5% down FHA, mortgage programs. I mean, all these programs that encourage home ownership is a U.S. phenomenon for sure.
Yes.
However, you get the naysayers that now say, well, look what you've done. Now you've appreciated the housing market by 25% in 2 years, or whatever the number is, right? It's somewhere in there, right? We're doing, now we've had 2 years of some double-digit home price appreciation. And some people point at the Fed and said, no, you shouldn't have done that because now you've driven up prices and yada, 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 right? So I'll agree with that a little bit. However, the thing, and Chris, you know this, I know this, here in Albuquerque, we've been seeing a strong real estate market all the way back to 2019. We knew at the beginning of 2020, this is, December of 19, January, February, that 2020 was going to be a busy year for real estate. And at that time, we were at 4% interest rates, right?
Yes.
So the demand was already there,
right?
COVID and interest rates and, less people wanting to put their homes on the market, all that stuff drove the supply demand, which drove prices. And we're still in that cycle.
Yeah. You'd have to get granular in that to really break down. It isn't any one single thing.
Right. Of
it
course.
Certainly
it
wasn't
never
just lower interest rates that drove up home prices.
Well,
it could have been that there was a pandemic and folks stayed home or were laid off and were in no position to list their homes or move or do anything different, right?
I think our natural inclination is we just want the binary, right? We want the simple 1-point answer, right? It's, again, if you go back to 2008, you can't just say, well, it was just this, right? Or it was just this.
Right.
It's a lot of things. It's the perfect storm of events.
It could be that folks realized that they could work from home now. And so why sell? Why move? For a while, people would relocate for employment. Well, that went out the window for 2 years and may never go back to looking the same, other than, and you and I talked about this earlier, something that could affect the real estate market when you think about it. Now that we can work remotely, why would you work remotely in a cost of living area like California if you can work remotely in a cost of living area like New Mexico? So I think we might see some migration out of higher cost of living areas for those folks that can keep the same income but relocate somewhere else. So
actually, I've got an interesting, I always love these counter narrative stories. I saw some research I was on a National Association of Realtors conference here just a couple days ago, doing a kind of a wrap up of 2021 and looking at 2022. And one of the things was a demographer, and he was talking about moving patterns. And the thing that was interesting, actual moving is down for 2021 versus 2019. So, but you everybody thought, oh, wait, everybody's moving, right? But it's actually, it's not. People are not moving quite as much. And we see that here. If we just go really granular here locally in Albuquerque, the number of homes, on the market, coming on the market is lower, this year, definitely lower in 2020. Than previous years, 18, 19, 2017, and so on. So, the number of people putting their homes on the market has declined, which again is skewing this whole supply-demand question. Okay, let's do some predictions, Chris. So,
wait,
Go ahead. Go.
No, I was
yeah,
going to say
finish your point.
No,
yeah.
I was going to be facetious and say predictions. My crystal ball shattered about mid-March.
Yeah, I know.
And
I know.
it hasn't worked since. And just before I want to make sure we get onto this topic. I know some folks are concerned about a repeat of foreclosures.
Yes.
Like that took place in 08 through 2010.
Yeah.
Difference back then was the immediate onset of the recession hit housing prices right away. Housing prices began to decline rapidly. And so when folks, for various reasons in the economy, were in a position to where they weren't able to make the house payment, they were also upside down or break even at best. They didn't have equity in the home. So it was sort of a double jeopardy situation. Whereas now, and I'm sure you could validate this point, is that folks are sitting on equity in their homes. They have money. And so we have the furlough programs that are out there, which was a focus of concern. Are these folks going to just simply never get back to
the forbearance programs?
Forbearance
Forbearance
programs. We hear whispers and rumors and things that the federal government and other folks are really going to try to push for investors to get creative to help these people stay in their homes so that we don't have foreclosures. But ultimately, in the end, I think we're in a different scenario where, because if somebody isn't going to be able to come out of furlough, but they have 10% or more of equity in their home, then instead of waiting to go to foreclosure and walking away from a home, they could choose to list the home, put it on the market, and then at least walk away with some funds and get into a rental situation. So there are things about today's environment that are different than 08, 09.
And that's just one of them. The strength of the loans, we've already talked about that. The type of buyers that are in these homes that actually own these homes.
Yes.
There's so many reasons. And, the forbearance statistics, at one time there were over 7 million people in the country in the forbearance programs. Now it just dropped below 1 million. It's now like 900,000.
Yes.
And I have a report that I can run here locally for New Mexico that runs and looks at all the lis pendens filing. If you don't know what that is, that's the pre-foreclosure filing. That's when a lender goes to the courts and says, "Look, we're going to be foreclosing this property." It's like nothing. There's very, very few in the pipeline right now. So we'll keep an eye on that and see, but we definitely don't see a repeat, of what we saw.
I can't see making a comparison between today's market and 2008, 2009.
I really, if we want to look for a, I don't like this word, but some sort of catastrophe or some sort of big challenge that we have, or crisis. That's the word I was actually looking for. The crisis. It's the affordability. Yeah. Right. We can't have home price growth or let me put it this way, housing cost growth that's both purchase and rent at whatever it's been, anywhere from 10 to 15% per year, when you have wages kind of stagnant.
Stall. Yeah. Yeah.
So we can't keep doing that. So that's really the challenge, is at some point we're just going to get to a wall where people just can't afford the roof over their head. And there's I will tell you, on this conference I was on the other day, there's a lot of stuff in the policymakers' agenda about housing vouchers, down payment assistance programs, affordable housing programs.
Yes.
That one of the things I'm hearing a lot about, Chris, is people are wanting to encourage local municipalities to do better on high density, allow for more high density, allow for auxiliary dwelling units, basically putting the mother-in-law suite in the backyard or whatever you want to call it.
Yes.
So there's a lot going on in that world right now, but that's really the crisis right now, is the affordability or the building affordability
and that's
challenges.
Push creativity,
right?
And that creativity is really to everybody's benefit. So as we can get more creative and offer more housing solutions, then yes. And I, in another life, I spent about 14 years in the public housing arena. Yeah. And had been to traveled to a number of wonderful cities that had come up with excellent mixed investment solutions for, having a variety of affordable housing scenarios. So I think we're going to just see more of that creativity moving forward.
Yeah. My hope and wish is that if we do this, that they're not that there's some sort of ownership program,
Yes.
and not just giveaways.
Absolutely. And that's some of the things that I've seen. I've seen cities do miraculous things. I was in Virginia, just on the D.C. border, was working with some folks there at a housing agency, and they had built these, it was a townhouse and then 2 condos and a townhouse and 2 condos, and it was mixed. It was mixed purchases. So you had some people that were buying them outright. You had some people buying them through affordability programs. Some of them were actually public housing. And so there was this incredible mix. And it was all wrapped into an HOA. I mean, the properties were kept and maintained. And so you had doctors and lawyers buying these to be that close to downtown D.C., but having other people benefit to get into the same places with affordability programs. So I've seen some really creative things.
And we need that in the Albuquerque area. If anybody's listening that's, got the ear to some of the policymakers in the Albuquerque area, we really do have some challenges in that area, but it has to be done right.
Yes.
Some of the zoning stuff, streamlining zoning,
yes. And the examples are out there.
Oh, they are.
So nobody has to reinvent the wheel.
Yeah.
King County, Washington did some fabulous things with their mixed investment developments, which are beautiful neighborhoods that would rival the size of a development like Cabazon in Rio Rancho.
Yeah.
So the role models are there, the blueprints are there. Nobody needs to invent the wheel. We just need to send some representatives to go see how it's done.
Well, the big challenge is the NIMBYism, which is not in my backyard.
Yeah.
I have a friend that tore down an apartment building that was just a dump, and it's going to build this beautiful apartment building back in its place, and he can't get it through zoning now.
Yeah.
And it's just, it's happening.